Don't even think about launching a fund until you've done what my next guest suggests. Join me on this episode of Making Billions, where we chop it up with a 3-time exited founder on real talk on what it takes to be a powerful asset manager in this alternative investment fund space. All this and more coming right now. Here we go. Hey, welcome to another episode of Making Billions. I'm your host, Ryan Miller, and today I have my dear friend, Chris Van Dusen. Chris is the senior partner at a firm known as Solyco Capital that has gone to do, get this, over $300 million in transaction. What's more, Chris is a 3-time exited founder that specializes in venture capital from seed to Series B investments. So what does this mean? Well, it means that Chris is an expert in venture capital, closing deals, and building reputation, relationships, and results. So Chris, welcome to the show, man.
Ryan, thank you so much for having me. Excited to be here. Love the show. Big fan of yours for quite some time. So excited to be here and finally get to do it in person here together.
Yeah, man, it's good to have you. We've been very fortunate to be in the top 2% of all podcasts in the world. We're number 3 in private equity, if you can believe that. Number 3 in the world. And it's all because of amazing guests just like you. So I'm excited to chop it up with you, talk about all of this transaction volume, your exits, building reputation, relationships, and results. We know about that. So we've known each other for a little bit now. And I'm just curious, from your perspective, there's a lot of people who listen to the show all over the world. Some of them are just starting out. But even if you're not, it's really good to brush up on the fundamentals. So from your standpoint, when someone's starting out in your industry, how do they win and get early points on the board? And then we'll talk about how they not lose after that. So how does someone starting out, how do they win?
So it's a great question, but I'm going to sound like Warren Buffett, even though I am not. And that is invest in what you know. And it seems very, very straightforward. But traditionally, before you get into venture, you get into private equity, you get into even angel investing, right? You're doing something in your career. And in that, you're learning about a certain sector, certain industry, or let's say outside of it, there's just deep passion for something, right, that you're not employed in. Both of those things are where you can have an unfair asymmetrical advantage to the knowledge gap. If you, take me, right? I did a lot in consumer packaged goods. I know a lot in sports. But when you get into biotech and pharma and these big complex ideas, the education chasm that I have to go over just to be able to say, I know enough that whether or not this deal is going to work, I know the competitive set, I know how hard it is to get contracts or do something in that space. I'd have so much more time compared to something I know. And that's the first thing, is really to focus there. You're going to understand your total addressable market better. Like I said, contract value. And also you probably have a deep passion for it because you spent a good portion of your career or your passion's really focused on it. That's number one.
Yeah. Thank you for that. Investing what you know. So you mentioned TAM, make sure that is what you need it to be. And then do you factor in any of the macro environment that deal exists in? And how do you perceive that when doing your first deal and trying to get some points on the board?
Yeah. So I do very much. And we can look at the difference between investing in 20 and 21 versus 22, 23, and even this past year in 24 when you look at interest rates and the cost of capital. So I look at it and say, what money or what capital is this business going to need on a 5-year run, a 7-year run? Because venture deals specifically are going to be much longer. And are they in a growth mindset or are they in a yield mindset? And those are very different, right? So when we look at capital markets and you can see the cycles, when you look at low cost of capital from an interest rate perspective, you're going to be in a growth cycle. That is high revenue, low yield. And that's to get market share, to keep growing, to get bigger. Think of a land grab, we would say. And then on the other side, when cost of capital is higher, a la what we're experiencing today, you're going to see more and more companies focused on yield, which is standing on their own 2 legs, not necessarily just living on investor capital. And that's true in venture as well as big established companies at the capital markets side. So we have to look at it because sure, we might be lead your seed, lead your A round, but if you still need a massive amount of money and your B, C, and D, including debt, that might not be available to you. So that's an execution risk from our point of view.
Brilliant. Now you said that's number one. So number one, invest in what you know. We got a few tips on that. What do you have another one for us?
I do. And this is specifically, as you mentioned, starting out. Everyone wants to launch a fund. My advice, don't. And maybe that's good, maybe that's bad from your point of view, but here's why. When you look at a fund, it's really an AUM game. We've got to raise a certain amount of money. We have a management fee, you've got carry, and we have to deploy that money into this sector, this mandate that we've designed, but then into multiple companies. Well, if you're starting out, I would contend you don't have all those great companies identified or the relationships in that sector that are going to get you the very, very good blue chip deals right away. Instead, you can take your time, find a great company that you believe in, go out and put together what they call an SPV, a special purpose vehicle, or a different instrument to receive investor capital, treat it for just that deal and deploy it. It's going to save you a lot of time and effort, especially if you don't already have this high net worth family office or wherever you're raising capital for to come in. I've seen many a fund burn out because they weren't able to raise capital quick enough. And, in your show, you talk about the 3 R's, right? And reputation being a very big one. If you commit capital and don't follow through or follow through late, I will tell you what, that's ruining one of the R's. And so you have to go out and try and raise this and make sure you're going to do it. And it's much easier to do in an SPV model, deal by deal, than it is to go try and raise a fund and not be able to deploy.
Awesome. Yeah. So, I've helped probably over 2,000 people to launch their own funds, and some do better than others, like any industry at all, ever. And one thing I can tell you is, folks, I absolutely agree with Chris. What he's talking about here is saying it's not that funds are bad or don't launch a fund, because remember, the context is we're talking about when you're first starting out. And so funds think of it like a tool, and it is a specific tool for a specific job. And I'm generally speaking here, but typically when you're launching a fund, if you do a traditional 220 structure and you're launching a fund, those are meant for large volume or AUM, small margin. And if you're trying to do small volume and small AUM on a small profit margin, you're going to go out of business. And this is the problem that people have. It's not because they didn't understand real estate or hedge funds or whatever it is they're doing. It's because they were in the wrong vehicle. And so you can crash and burn on your dreams potentially by launching a fund too soon. Would you agree?
100%. And what ends up happening is you can't negotiate the right depth in your own deals, or just take the economics on a standard 2 and 20 model. You go raise $10 million, right? You're sure you're going to have a couple $100,000 coming in. Maybe that takes care of your salary. You're going to have no support. You're going to be having to file. You're going to have to keep operating capital to keep all your registrations filed for the fund. I mean, it will eat it up quickly. Oh, and by the way, the cost of raising capital, where's that coming from? Because I don't know about you, but jumping on a plane to close a nice chunk of capital, going to lunches, right? It sounds fancy, but at the end of the day, that's an expense line item outside of what you're doing to support your own self and family. And so being able to do it in a smaller little deal instead of having to put this whole thing together, I think it's very different. Yeah. So syndications, SPVs, those are good. And you may disagree and feel free to do it. But what I've seen, some people say this number is too small, but I was like, don't even think about launching a fund until you're at least at 50 million AUM, preferably 100. Because then at 100, 2% management fee, if you're even able to get it right now, reports are coming in that actually it's about 1% right now. So let's just say, let's go with the market. You raise $100 million at 1% management fee. So management fees are going to cover your op costs. At 1%, you only got $1 million to manage $100 million of volume. Okay, so only $1 million. That's a couple of salaries. You might be able to hire a mid-level investment banker and an adequate lawyer and some graphic design, and you're tapped. And so you can see if you did that on a $10 million fund, so you can launch a fund with nothing. You can, doesn't mean you should, but you can do it. And that unfortunately can stand in the way, not because you don't know what you're doing, but because you do know what you're doing, but you're doing it in the wrong vehicle, which also can damage reputation, relationships, and results. I absolutely love it. So it comes full circle. One thing I would add too is if you look at what you're going to need to do from a fund basis versus specific company that you want to invest in, an SPV, I can evaluate that company, I can go deep, and I can add value, right? And adding value, I think, is extremely important, especially on an early stage investment. When I go and let's say I raise that 10 million and I set it out equally, 1 million in 10 companies. Now I have 10 companies that I need to focus on and help. But remember, I don't have staff now to help me. I have analysts. I have me. And maybe that's fine because we're in a minority position and they don't need all the help that they would traditionally need from the lead. But I contend that getting invested in early stage companies is because you have a passion for the entrepreneurial journey and you want to be able to provide value. And so starting smaller is a much more prudent way of doing it than going right to a fund structure, in my opinion.
100%. Because it gives you the space, because you don't have that pressure of compliance costs and all that with audit and all, unless you really want it. But that's that would be bizarre. But in all seriousness, when it comes to doing an SPV, just getting that experience or syndication, getting that under your belt, it's not only a good idea, it's absolutely vital if you actually want to if you're an aspiring or emerging fund manager or you have those dreams, just put in the reps, show that you can close deals, you can run a team, you can raise capital, you can operate a business, you have processes. Like there's so many things that have to go in place Because a fund, don't forget, you're starting a financial institution. That's a big deal. And and which is amazing, but you got to be ready for it. And it's maybe you're ready, but not able, or you're able and you're not ready. But then remember, at the end of the day, it's going to be you standing in front of an investor, convincing him that you can take down $100 million. You can take down $500 million or $1 billion. And you're like, hey man, it's my first deal. It's like, dude, go do a couple deals. Cause I've been this guy. When I started out, I was a kid. They were like, just do a couple deals, show that you can make money. I believe you know what you're talking about, but unfortunately you haven't been battle tested. And so I need to see you in the industry. And so I went out and I did it. And now we're here. And so if any of you are listening to Chris and I, that is a great way to start. And sometimes, and I remember my son, I'll be a little personal. So my son, he's 8 years old. He was in running club and he ran too hard and he was finishing really bad. So when we practiced, his time was really good. But during the race, and there was a few of them, he was so slow. And the reason why is because he was so amped up. It was his first race ever of his life. He was so amped up that he just went like crazy and then he'd hit a wall and then he'd have to walk. And then he'd sprint like crazy and he'd have to walk. And so my advice to him is the same to the rest of you. Go slow to go fast. Slow it down and you'll find that your finish lines, you will cross them faster if you actually scale back a bit in the beginning. It's the same exact principle. I love that. Now, we talked about how to win, but also avoiding some of the downside risk is another component when you're entering in this industry. So from your perspective, what are some principles that you found to help beginners to avoid losing in the beginning?
Yeah, the biggest one that people focus on is, similar to what I said, understand what you're investing in, make sure it's, something that has some hedge against what might happen on the macro side, right? I can give you all those. The thing that no one really focuses on are the founders, right? We go into due diligence and we evaluate the company, the TAM, the potential, the exit potential for and who the suitors might be. Then sure, you look at the founders, and personally, I love investing in founders that have already gone through it once. And the reason being, and sorry, it's selfish, but we're investing capital here, is if you've done it, you have done that journey already. And for those that haven't done the journey, it is tough, period, hard stop. And so as we look at the founders, I want to evaluate two things. Do I believe they have the ability, capacity, and know-how to actually go do the things they say, right? But then in the case of co-founders, what is their real relationship like? And I don't have a specific percentage. I'm sure that you could track it down somewhere, plus or minus within a couple points of percentage points. But I bet you more than double digits of startups that received funding failed because the two founders didn't get along. Nothing to do with the idea, nothing to do with the potential, but they had a hair difference in what they believed or where they believed the company should go, what it should be and where it should go. And that's hard to root out in diligence, because for anyone who sat through a management presentation, everyone puts on their Sunday's best and act like kumbaya best friends. And so you never really can tell in the straight and, focused, we're going to go through these management presentations, we're going to go through these questions, we're going to go in your data room or do all this. What I like doing is take them out for lunch, take them out for coffee. I don't advocate this, but take them out for happy hour, right? If they golf, take them golfing. See who they are as people together, separate. Wait for that, loose lip to sink in and talk about a little strife in relation, like the little things. And that might sound nefarious and it's not meant to, but at the end of the day, we're investing our capital and we're investing investors' capital. And there's a responsibility to truly understand who you're now going to partner with, right? And that doesn't, other than doing standard background checks, the other thing you can do is really understand who they are as people. And then as you do that, how good is that relationship? Does everyone know where they fit? Are a clear vision aligned? I mean, I've heard this from another individual who I feel awful I can't give him credit for, but the CEO's responsibility is three things: vision, culture, and fundraising. Now, you should be doing those all day long. If you have co-CEOs, that worries me. If you have co-founders where one likes doing the other's job all the time, that worries me, right? You see a great enigmatic CEO, right? The P.T. Barnum that every startup needs, and a great CTO that's sitting there focused on where they're going and owns it. I start getting a lot more comfortable than I would to have two people saying, we're two Brahma bulls ready to go take on the world. Because that starts to, over time, potentially separate. Because they are two very different people when you get out of the vision and get truly into what they want to achieve. And there's a lot of things that can go wrong if you haven't done that diligence.
So it goes right back to the relationship side. And I love that you brought this up, Chris, because this is important, is to say too often as asset managers that we are, or investors, or whatever it is you're trying to do. You don't even have to be a fund manager to follow these principles. Maybe you're an angel investor, you got a few bucks and you just throw it at a couple startups. But I think the thing that gets lost, and this is why I say I got a lot of love for accountants and lawyers, but they have their place. And I always say from my own experiences, they make a better caboose than an engine. So you don't ever let them lead the deal. And the reason why is not that their skills aren't good. Of course they're good. I'd never do a deal without my accountant or my lawyer. However, and nor should you, right? I'm not giving financial advice. I'm just saying, here's how I do it, is to say they're the final one at the end. I'm leading the deal. But when there's a culture of that, of accountants and lawyers, you rely heavily on contracts and financial statements. Right? You're smiling because you know. So you see this over reliance, and we call that due diligence. We're saying, what are the contracts? What are the legal things in place? Are they getting sued by someone I don't know? Is there, okay, good. I mean, yes, figure that out. Obviously, figure that out. I'm not saying don't figure that out, but what I'm saying is that's not enough. And I think that's what Chris is saying, is he's saying like, hey, you got to understand the stuff that's not in the financial statement, the stuff that's not in the legal contract. And if you can unwind those, and what he's saying is he actually offered some suggestions on how to do that part of the due diligence, is saying, how's the relationship? Because you can have the best pro forma projections this world's ever seen, and it still falls apart because the founders can't even get along. And so it's not enough to deal with that. That's number one. Number two, I love what you said about founders who are experienced. Chris, can I tell you, if that's all right, can I share with you my dead giveaway of an experienced versus a new founder? So the thing that I've found that really impresses me, now I'm teaching people how to sell me. I'm not doing that. Don't pitch me on this. I'm just saying, for if anybody's an asset manager, you have a really good experienced founder, because a new founder will always talk about product. And that's good. You got to have a good product. You got to have something that drives value in the company. But an experienced founder, and Chris, you're a 3-time exited founder, you would know this. An experienced founder not only focuses on, yes, we got to have a superior product, we want to win, but they also talk about distribution. That's when I know I've got a winner and I've got an experienced founder in my hand, is they're saying, we're going to have an excellent product, and here's how we're going to get that to market. Okay, you've been through the gauntlet. You know, it does you no good to have the best product in a cave. So when you have a founder or an investor or a fund manager or anybody, please hear my voice. Make sure that distribution is figured out. Even if you don't have it set up, investors want to know you have a plan. Show me not only that you have a great product, but you have a clear path to get this great product to market. How are you going to do that? Anything you can add to distribution of your product?
Yeah, it's a funny story. So career-wise, and I'll save the long part of that, but I did a lot working with startups in the 2012 through about 2016 range. And there was this narrative going around, especially out of the Valley, that there's no need for marketing if your product is great. And while I can see theoretically what they mean, the idea of, the heroin drip of Facebook ads and Instagram ads and all this, where I spend all this money, I need to overspend to get customers. Yeah, I get that. But I think that was misinterpreted as product is number one. And by the way, I'm not going to disagree with you have to have a great product.
You have to.
There's actually a GP at Benchmark who said this on a separate podcast. If you're selling a sailboat, everyone's going to try and say the rigging and the mast and the leather they used and how far it can go. But an experienced founder, what you really should be selling is the wind. Because if the wind is good enough, all boats will sail no matter. Yeah. Right. So you have to have a great product, no doubt. But if there's no wind, then that thing's just sitting in port the whole time and it doesn't matter. And so understanding to say, I have a great product. Here's why it's better. Here's who's going to want it. Here's how I've identified how it'll be distributed. And oh, by the way, we're not going to overspend on marketing. But if we did marketing this way against this distribution, we will own this much of the market in this amount of time. And if we do that, then this is what our value is going to be in a very small amount of time. And that kind of just walk through is exactly what, to your point, an experienced founder will do. Because if not, it's look at my beautiful widget. And I'm like, who's going to buy it? And they're like, everyone. And that's another piece of due diligence, which is if everyone is your customer, no one is your customer. So another mistake, and I'll throw this into how not to lose, is while you're doing your own diligence, truly look and say, do they understand the market they're going after? Because what I find a lot of times is, and I made that joke a second ago, everyone's my customer. This is going to revolutionize every industry. And while that might be true, that is trying to eat an elephant. And if you're raising venture capital, you don't have a 10-year runway and billions of dollars, right? You have I'm going to start in this vertical, this sector, or I'm going to have these two because they correlate. And I'm going to go an inch wide and a mile deep in those. And I'm going to use that piece, right? That as a case study to show you what we can do in another vertical, in another sector. And really the reason why that's important is every new one you go in, we like to think, oh, it just translates easily. What doesn't, however, and that's not product changes. I'm talking like a software company. It's not product changes, right? It's be biotech and a brand new, part of how your product could work in saving a different thing. But what ends up happening is you don't know how long it takes to make sales. You don't know how much staff you're going to need. And what ends up happening is you burn all this money identifying what you should be doing behind the scenes without standing up an entire division to do. And what's easy is when you've come and dominated a market and then go and say, I'd like to dominate a new one. By the way, you have traction, which means you have a higher valuation you can command and less dilution for the next vertical you go after. And that becomes a better way to leg into your growth, right? To your point, go slow to go fast. That can also work when you're doing diligence and understanding their plan of distribution and success.
Brilliant. So as the saying goes, the riches are in the niches, man. So make sure that you really understand your client and stick with it, right? Even this show. And by the way, this applies for fund managers as well. So I've like I said, I've helped thousands of people. And in order to do that, I've heard a lot. And the craziest thesis, and it actually made sense, but the craziest thing is, Ryan, I got the best idea. We're going to start an investment fund that's going to do crypto, cattle, and real estate. And I was like, those are very different investors. And, I could see why you backed into it. I won't go into too much, but it was wild. And so you're like, hey man, just pick crypto or real estate or commodities, cattle, whatever it is. Just start there, right? Go slow to go fast. And so in order to do that and to really get that down is to say, hey, if you want to be successful, don't be everything to everyone. Whether you're a fund manager, still a startup. Whether you're a startup, a founder, still a startup. You still need the distribution. You need to understand who are you pitching to, because if there's alignment, there's typically capital that flows in the right direction. When there's not alignment, you're like, I got to find someone who's looking for crypto, cattle, and real estate as a potential solution for his money problems. Okay, that's a little too niche. So keep it simple, keep it niche, and pitch the crap out of it. I love it. Is there anything else that you could advise either fund managers or entrepreneurs on how not to lose?
Yeah, I would say the last thing is, if you're to do early stage venture, and especially the way we talked about it, the non-fund model, right? And let me set the stage. If you raise a fund, traditionally, you've already raised the capital. Therefore, when you find a deal, you go deploy the capital, right? On the other side of the coin, if you're going to do an SPV, and let's say you love the deal, you want to put your money in it and get some of your friends, families, colleagues in, whatever it is, some other high net worth people. And you may say, I believe I can get $500,000. And you go through all the diligence, do everything, commit it, and then sign a time to fund and don't deliver. As you talk about in the show, you have 3 R's, right? Reputation, relationships, and results. Whether or not you're on the fund manager side or the entrepreneur side, right? Because it's basically life advice there are the 3 R's. But if you're not going to follow through, you put that company that's relying on capital into a spot during a formidable time. And that has ripple effects to reputation, to when the results that company has forecasted comes in for every other investor and themselves, right? And all of that can hurt back to your reputation and damage relationships. So if you're going to commit small and over deliver, ask for more. You hear the term all the time. This deal is oversubscribed. It's oversubscribed because they took more money than they had planned. That's not a bad thing every once in a while, right? And so if you say, look, I know I can get $100,000, but I'd like to reserve the right to maybe go up to 250, 300. You committed the 100 and you're reserving the right to go up if you find the extra capital, but make sure you're realistic in what you commit because it can damage companies.
You're right. And even to echo that, maybe we'll take that even a level 2 if I could, because that is phenomenal advice. Even another reason to do that is I have something where I'm raising, and if I teach people is I say no kingmakers. And so the reason why I say that is in raising or over raising, sometimes it's tempting to say, I'm $100 million fund. And for some reason, I don't know what it was. Maybe they liked your suit, but for some reason, your emerging fund manager got no money and they give you $100 million. Like one investor fully subscribes. Well, the thing is that person's now become your kingmaker. And even though you're the fund manager, they're your manager. And so just make sure oversubscribed is good. But if you try to over concentrate investor capital, either in a fund or in your startup, you run the risk of having kingmakers. And by the way, they can take your crown and make someone else king. So making sure, and so a rule of thumb that I have, and feel free to agree or disagree, if you're in the fund management space, I will say no more than 10, 15% of the total AUM for any single investor. So what does that mean? It means if you got 100 million, you ask them to throttle it down. And I'll always say a joke. I'll be like, look, there's plenty of time for me to take all your money. This is not one of those times. So let's just start out. It's a $100 million fund. Let's start you out with 15 million, and then we can talk about scaling up from there. Anything to add to that?
No, because if you do your job right, there's a fund 2 and there's a fund 3 and there's fund 4. And if this individual has a hankering to give you that 100 million, you just need to space it out. But also, we've talked a little bit, but most firms don't just have one deal, meaning one fund. They may have, especially at size, a fund that does, to your point, crypto, and a fund that does cattle, and a fund that does real estate. And so you could say, if you want exposure to each of these, here's your placement allotment, right? I'll allocate this much. Now, that just went from 15 to 45, right? You're closing the gap, but they're not inside of specifically one deal, one fund, so over concentrated. We're now, and I don't want to say the tail is wagging the dog because capital is the most important thing we have, right? But it becomes you managing partly their family office instead of you managing your fund that you are actually in control of.
Yeah, absolutely. I love that. So solid advice, brother. Now, we wouldn't be much of a show called Making Billions if we didn't talk about the market. So early on, we talked about finding businesses and assessing macro shocks. And the macro's been ruling the last few years, that's for sure, with COVID and interest rates. And it's all we're hearing about, these large sweeping things that are affecting global economies or even national ones. And so I'm just really curious about the market. I know it's not the market, but the markets that you're looking at, the sectors you're looking at, the fundamentals you're looking at. What are you seeing out there?
Yeah, I mean, I'll start capital markets, and just, for everyone listening, my day job is not being a capital markets analyst. But, over the last couple of years, we watched interest rates kind of go crazy and they've started to pull back a little, but I believe all that's baked in. I think there's a little overvaluation on a lot of companies and certain sectors. But overall, what has happened is when you have this inflation, which is causing interest rates to go up, it impacts many different sectors, right? And venture is not immune to it. What you ended up having is a lot of companies that had to mark to market some of their investments, and those were marked down. Right? Those are down valuations from when they invested. You have a lot of dry powder sitting on the sidelines, right? For most big funds, and I'm making gross generalizations here, they go raise capital, right? They do capital calls when they find deals, but eventually they do raise the entirety of their round, or they have these kind of dangling out their capital calls that they need to make to deploy their capital into companies. And I know on good accord from many people I've talked to who have funds that finished raising in 21, even 22, that still aren't fully deployed. And we're in 24. And traditionally, you're going to have a window of time that you've built into your model as a fund to deploy that capital so that it has the 3, 5, 7, 10, whatever your hypothesis is for the total fund's life cycle to be deployed, to bake in the oven, if you will, right? And be ready to enjoy. And if you're now a year and a half, which is more standard from starting your fund to deploying the capital, to 3.5, 4 years, what do you think that does to the model? A, it pushes everything out. So now your early investors are in potentially much longer. Maybe that's good. Maybe that's bad. That all depends. But there's a lot of dry powder. Now, why are they investing? Valuations have definitely come down. We can argue that it's hit the bottom. Depending on the industry, I'd agree. But you also have the thing like AI that is an absolute bubble. When you're looking at companies that have pre-revenue seed rounds at 100 million pre or post, that tells me there's something a little wonky. It tells me there's a lot of capital going there. And it kind of is reminiscent of the old early 2000s tech bubble. There were a ton of winners. There are a ton of losers. So you just bet on everything and hope that you made enough good bets to make up for the bad ones. And, we can debate the portfolio theory all day, but that's actually built smartly. And I'm not sure that investing in X amount of $100 million post-money companies is going to give you the type of return you want, unless you had picked one brilliant company within that. Venture capitalists, I think they're doing great if they pick 25%, right? It's batting 250 in the major leagues. So you better hope that of the 10, 12, 15 companies you picked in your fund, you have one that's going to be an absolute gangbuster. And if not, well, then that hurts that third R there in results. And that ends up being a big problem, right? And so I think there's interesting things happening. Now, I say that on one side of my mouth, but I also said there's great value out there. There are a ton of companies over the last couple of years that had everything going for them and just couldn't secure capital because everyone was scared to deploy. There are companies now that you can find that have, I believe, fair valuations, if not undervalued compared to what their potential is, and need a capital bridge or need to do an extension round at the same value they raised before. And you can get in at prices you never would at an execution risk trade-off, meaning a lower execution risk than you would at that valuation in years prior. And so it ends up being something that you can go out in market and find deals that are at a valuation that's fair, where you wouldn't be able to do that, I believe, in the 2021 range when money was cheap and free and everyone was throwing it in everything.
Brilliant. Yeah. So it reminds me of that model where you just invest in everything. My friends in crypto call that the shitcoin spread. So you just throw money at everything, and some are going to pop, most will tank, and you know they're garbage, but you're like, look, I'll just pepper it across literally everything. I don't know if that's possible anymore. I have no idea how many of those that are out there, but as a typical strategy they stole from old school VC. By the way, not recommending that. It's not a great idea. Do your due diligence. Make sure you understand what you're getting into. Don't just throw money around. So, looking forward, I'm just curious. You hear AI over all this stuff. What are you seeing out there? I mean, you do a lot of deals. You focus on founders. You've been one multiple times. What are you seeing? What's your opinion on this AI wave?
So, a couple things. If you started like the generative AI, which I'll get over my skis very quickly on, and I'm not going to pretend that I can sit here and talk for a podcast about all deep tech AI. There are going to be amazing models that win. I've always made the joke, I'm not smart enough to know what's a product versus a feature on these large language models roadmap. So a lot of the middleware for me is out right away, right? Meaning the products that sit on top. And we have this fundamental model of an operating system a la, iOS that you build apps on top of that people enjoy, right? So you look at ChatGPT or OpenAI came out with their marketplace and everyone's going to rush to do this and get capital towards it. Absolutely going to be winners. Not smart enough to know which ones they're going to be, right? Then on the total other side, you have everyone saying they have AI, and it's not AI. It's a very small use of something that's clever and maybe learns a little, but it's not truly what we would consider AI. But they put it in there, and it's no different than what you've seen in any other, basic algorithm that's used in these SaaS products, right? To learn and to give you recommendations, right? I have a beauty care site that uses AI to tell you what's the right thing. And it's like, no, they just aggregated off your interests and gave you something. I wouldn't call that a use of AI. In the middle, there's companies that are doing a practical use, and I will give a little plug for one of our investments, AI.io, practical use of AI in scouting and player development. Really fundamentally amazing piece of technology that will change a lot on how people are scouted globally for sports. Great. Not a big language model, but a practical use of AI in today. That's where I see a lot of interest, is figuring out how to use it more practically. Is that going to be the big game world changer that powers, Android robots one day? Probably not, right? The other thing, and I think it's most applicable to this discussion on AI, is we have 34 portfolio companies. We would be naive not to look internally and understand how AI can offset burn, right? Can change the financials within a company, how it can be used to make companies better. And this is things that are off the shelf now. Wouldn't call them an AI company, but utilizing the tools to make your company better. I think everyone at every company should be looking at that. And that doesn't mean building some big data lake walled garden. That means looking and saying, hey, I run 10 call centers and have 500 employees. Could I use certain bits of AI technology to get everyone coming through 80% of the way there, right? Without having to talk to a human. And now I can change the entire economics of every call center, right? I'm not advocating the loss of jobs for humans. What I'm saying is there's efficiencies that you can utilize tools today to fundamentally change the economics of your business. And if you're an early stage startup in a situation like we're in today, going from potentially revenue and growth over yield and need to bring down your COGS to get more yield base and have a smaller burn, what a great way to do it than to look at tools that are available. And that's, I think, where AI is finding a great place today outside of the big media hype and, what I would consider a bubble.
Man, brilliant. Yeah. So it is interesting to see where this will go, and if this is a bubble or just the start of a hard bull run in a certain sector. I guess we'll see. The dots connect when you look back. So,
well, it is the great thing about having an opinion, right? Yeah. Someone smarter than me said this as well. You're going to piss people off just by having an opinion that you've said out loud because it's your idea and other people won't agree. So maybe some of your listeners are going to say, he's absolutely wrong. And that's okay. And then there's listeners who say he's absolutely right. And that's okay too. But it's basically my job, if I'm going to be a professional investor, if you will, be a fiduciary investor dollars, to have an idea and a thought around what's there and believe in that. And they come behind or not as well, right? And that's kind of my job, if you will, as one of the senior partners of the firm, is to have a thesis on what I believe and then make the appropriate recommendations for investments because of that.
Brilliant. Well said, brother. So as we round third base, one of my favorite parts of the show, and that's why we save it to the end, is I really love giving people an unfair advantage. And so you've done a lot from startups, investing, and sports, everything. So from your experience, what are one, two, or three maybe competitive advantages that you can provide our listeners today?
So this one never goes out of style and goes out of vogue. And it's actually pretty apropos coming from an AI conversation, right? Because the thing in AI I will contend today can't have is great human-to-human relationships. And whether or not you're an entrepreneur raising capital, or you're an emerging fund manager or an established fund manager, your relationships are the cornerstone of everything you have, from deal sourcing to raising capital to finding strategic partnerships for your portfolio. It is your network. The question I get, I do some mentoring myself, right, for people who want to do things in venture, is how do I do that? Well, unless you were born to a certain type of family that went to a certain type of school that went on to get your MBA, you might not have a big network. Or you might have the network you have, and it's looking across the bow and saying, how do I build it bigger? What's important to me? And that's not a transactional relationship. It's saying, I want to meet great humans, and I'm going to see where those great humans take more relationships for me. So I get asked a lot, what type of people do you want to meet? I say, if you think they're awesome, that's who I want to meet. That's it. Not, do they have money? Do they not have money? Do they have deal flow? Do they not have deal flow? I mean, ultimately, I need both of those things to do what I do for a profession. But meeting awesome people usually means you meet more awesome people, and then you meet more awesome people, and then more awesome opportunities come within the network and the relationships. And, to start practically, that means having to go to networking events. Ultimately, you'd like to go and be a speaker, but unless you have something to speak about, that's a really hard sell. So go, meet, talk to the speakers, get to know them. Right? Like, go put yourself out there. And it's the hardest thing for people to do traditionally, at least I've found, is walk up to someone they've never met, extend their hand and say, hi, I'm Chris. That's it. And expect nothing other than a conversation, right? Because people usually go right on the defense at that point, unless you're in a situation where that's totally expected and normal. And those are the type of places you go. I don't ask for referrals. I think that is silly, just personally. And the reason being is, if you like what I'm doing, I make the joke, if you like my haircut, you're going to introduce me to other people who might like my haircut. That's going to happen, right? I think ultimately finding and nurturing great relationships and protecting them is the most important thing you can do. And again, really, this is advice outside of just private equity, venture, being a fund manager, being an entrepreneur. It's true in everything you're going to do. But specifically in venture and private equity, the best ones that I have spent time with have amazing networks that they have built, nurtured, protected over time. Yeah. And that really is, in my opinion, the biggest secret sauce. I mean, as we've joked about in conversations in the past, maybe sprinkle a little finance on top. That's usually pretty important to me in this world. But ultimately, relationships are going to be the biggest.
Yeah. And I absolutely love that. And those of you who follow the show, you already know reputation, relationships, and results. We said that many times, not only on this show, but also on many other episodes as well. Building those, I call those the R3, or those are your most valuable assets in your possession. So I love that you talked about going to masterminds, speaking on stages. Now, one framework, if I could share this with you and with the audience around the world, if this is helpful to you, maybe I can add to this amazing conversation we're having. But I break it out into three categories to really understand who's got the right energy, who's in your life, who doesn't need to be, or who's not in your life that should be, whatever it is that you're doing. So when you're really clear, you can try this framework, and please comment below or send me a note, whatever it is. I'd love to hear from you. But one thought exercise that you can do is break out your life into three sectors: umpires, vampires, and empires. So I created this framework for you to do that. And so when you have those relationships in your life, or habits, it's also relationships with yourself. And so those umpires are great accountants, great lawyers. And so I had to shift. My accountant, he did his job, but he only did his job. I found a new accountant who did his job and then went over and beyond and said, hey man, we need to make some adjustments here because long-term, I know where you're going. And if you do it like this, it might cause you a problem. It's nothing illegal, but we're just saying how you've structured your chart of accounts and all this stuff could be an issue. Great. Those are the kind of umpires. These are people, habits, friends that just keep you on the path, whatever that is. They all know what path you're on, and they will be outraged if you step out of line, and they will do everything to get you back in line. They just want to see you win, right? They're just doing their thing, nothing fancy. They're not billionaires, but they're just great influences. And those sometimes are your own choices. Second one is vampires. Those are habits. Those are people. Where are you leaking energy? Where are you leaking money? Get rid of it. Solve it, deal with it, and move on. And then finally, number 3, talking about relationships, is empires. If you're this kind of person, and if you're listening to the show, I'll assume you are, you're the private equity carnivore or whoever you are. I see you out there. But all of those, you want to really be around people who are headed in the same direction. And so if you're trying to build some empire, you're making billions, or you aspire to be making billions, typically you want to be around people who understand it. They understand it. And so as you plug the leaks and you have good umpires around you, they keep you in line, make sure you're doing things legally, ethically, above board. You're doing things that they know is good for you, and they will stop you from doing things that are bad for you. And you're also around people who are also about their business the same way you are, and they're building their empire, and you are too, right? They like your haircut, and everyone else around you likes your haircut, and they all have the same haircut, whatever that might be. But in all seriousness, these are the people who will say, hey, I'm so glad I met you. And now resource sharing happens. And now you start building this little community of empire builders. And that goes and that lands this plane on exactly what Chris said, which is like, at the end of the day, this is a relationship game. And some of the best VCs, best investors out there, they have this massive network that they're sitting on top of. That's the thing. It's not about launching a fund. You take a massive network and then you run it through a fund. Big difference. So don't launch a fund if you don't have the network. But if you do have the network, you might be able to pass that through those empire builders that you know, pass them through a fund, and you might have yourself a business. Anything you can add to that?
I think well said. At the end of the day, and I was thinking back, so I paused for a minute. Running your network through the fund, what a great way of putting it as you made that arc. Because it's so true. If you stood up a fund, had the greatest companies in the world you wanted to put in it, and you need no one to go raise capital from, that does nothing. Yeah. On top of it, you go raise $100 million. And most people go, well, you have $100 million, everyone's going to want it. And you're like, yeah, but there's that third R called results. So you just start throwing it out there, right? But hopefully you have a thesis or an idea on where you're going to invest. And that also requires being able to go in and have an ability to get on their cap table. And some of the best deals I've found are deals where it's almost closed. They're not running a traditional process where they're, running around trying to get everyone in. They have a lead. They're in. These are early seed stage, right? If we've missed the lead because I didn't do my job good enough to get the opportunity to compete for it, right? And you can get into that deal where it isn't readily available. And I'm going to sound a little weird when I say this. It's not that I don't want the deals that are being pitched to me, but I'd like some destiny in figuring out the ones I want to be in and then fighting hard to do that. And even if I miss it on their seed round, I want to be in on the A. And it's nurturing that relationship with the founder and the rest of the VCs that I like to call frenemies, because ultimately most of that VCs can't take down an entire round. They're going to take down a portion. And then they're also going to want to help this company succeed. So they're going to call their frenemies and go, I got one. You want to run side saddle on this and jump in, right? And I'm like, great, let me go do my diligence. That's a more valuable call than a cold pitch. Doesn't mean there's not great ones, but that relationship gives me a new way of looking at it because I know their track record. I know their results. I know their relationships. I know how they got in. And so it really comes down to that big R of relationships. Yeah,
that's right. So do you have a second competitive edge that you can provide our people from all your experience?
Yeah. I mentioned earlier on the show, invest in what you know, but more importantly, invest in where you can add value. So how do I get invited by that frenemy in, right? It's because they're looking going, well, not only can I bring in Chris and his firm, right? And their capital, but I know if Chris is involved, he knows this, and this, or these people, or knows how to do this, or he can be an asset as a growth lever, or he can work with my CMO because I was a chief revenue officer through the 3 exits, right? And one of the co-founders, he worked with our CMO or chief revenue officer on different strategies, or, we need to get into this market that I know Chris has extensive relationships in, right? Where you can add value and build that track record, especially through the SPV model instead of a fund, then you start getting inbound going, I want Chris because of that, or I want Solyco because of that, or I want Ryan because of that, right? And that is where you're going to get more. And it's tough because nowhere in the economics of that SPV potentially is you having to do any labor. other than identify and close. You're doing it because that third R of results is the most important thing you can merchandise to make everything else better. And so there's, I won't call it full altruism, right? You're going to make money on the back end, but you need to go in and provide that extra value and be of service to the founder, be of service to the team, and be of service to that portfolio company or that investment. And I think that's what's lost is a lot of people like to be passive founders, or they like to be so active that they want a job in the company. And it's that sweet spot of saying, no, I'm going to add value regardless. If it, regardless of if I have a job or if I'm getting compensated, I'm going to do it because it's the right thing for the business. And I think that's a big thing. And it's one you can establish your entire reputation on while you're doing your early deals, because then they want that hustler in there helping them drive. And the last thing I'll add, and I think it's important, and it's not the sexiest thing. And but we're pulling the curtain back on everything, right?
Mm-hmm. We are.
The question, as you're sitting there as an emerging manager, contemplating how you want to move forward, I think the thing that's not discussed enough is, do you have the grit, determination, resilience to do this type of work? Now, I'm not going to say early stage is harder or easier than later stage. I'm not going to get into private equity versus venture, but if you think about the fact that you are the center of a few different constituencies, you're the center of money coming in through LPs, you are identifying companies, you are a mentor to the C-suite or founders, you are also looking and helping them solve the hardest problems in the business only, because if it was easy, they're going to do it or their staff to solve those problems, right? You're going to not prescriptively work 80 hours a week, but probably work 80 hours a week or be thinking about what you're going to be doing that long. Weekends, not sacred because their business is not stopping. This is a full court press every day, all day. I like to say you're always working and never working. There's an old movie, Boondock Saints, and like 7-Eleven, I might not be always doing business, but I'm always open. The idea is you're always at work, but sometimes never at work because you're out at conferences and doing other things, right? But you're always of service to these companies, these founders, and specifically your LPs, right? Who gave you capital. That is a tough position. And do you have that desire? And I mean, ultimately, both your investors and you, if you do it right and get that third R right, are going to make a lot of money. And that's usually why people want to do it. And that's okay, right? I totally get it. However, are you willing to put in the work? And do you understand what it's really going to take to see these things through? Because I'm sure you've had the same thing happen. It's, 11 o'clock at night on a Friday, and you get a call from a founder saying XYZ just fell through. We got to figure shit out. And guess what you're doing for the rest of the weekend? You're helping figure it out. And so you're kind of always on call for things. If that doesn't sound fun, if that doesn't sound exciting, if that doesn't sound challenging, I certainly get very excited about it because I love it. But at the end of the day, it doesn't sound like something I'd really question whether or not you should. And again, this isn't hard advice. Don't listen to me if you want, but be prepared for some late nights and early mornings and everything in between.
Yeah, I love that. Absolutely brilliant, man. So before we wrap things up, is there any final remarks, anything at all you'd like our fans around the world to know?
Well, I do want to say, first of all, thank you for having me. This was awesome. If anyone wants to communicate with me, get in contact with me. I'm on LinkedIn, Chris M, Michael being the middle name, Chris M Van Dusen. Happy to provide my email as well. What I love is meeting awesome people. And what I've met, as long as I've known you, Ryan, and I'm sure your listeners are the same, awesome people. So anyone who wants to reach out, please feel free. My email's on the website, but it's also C, meaning Chris Van Dusen, and then at solycocapital.com. Reach out. Would love to hear what you're working on. Would love to understand. Maybe we can work together. Yeah, that's really the biggest thing. And thank you so much for having me.
Yeah, man, it's good to have you. So just to wrap everything up, never forget that this entire business runs on reputation. That's number one. Number two, not only should you invest in things you know, but also invest in things that you can really add value to that deal. Whether it's, like I said, you have to have that R3 and you pass that through a fund. You don't start a fund and expect that to happen. You get that happening and you pass it through. That's how you add value. And then number three, just ask yourself, do I have the grit to see this through? You do these things and you too will be well on your way in your pursuit of making billions.